from the beginning. This slide. So, okay.
Welcome, Rebecca.
Hi there.
Hi, good evening.
So we're jumping right into it. This presentation is about 20 minutes long. At the end, you'll have the opportunity to do Q&A. I'm Michelle Reyes, I'm the host, and our special guest speaker this evening is MARISELA LUPER, one of our advanced market specialists. And today, the concepts that she'll share with you, a lot of people can benefit, but especially realtors. So the floor is yours, MARISELA.
All right. Thank you so much, Michelle. Thank you, everybody, for being here. So infinite banking concept is our theme today, and just a little bit about me. This is me and my beautiful family that I love to show off, children and the children-in-law. And now my family grow, and so this is kind of a little bit of the picture with everybody, 3 grandchildren, okay? So the company that we're part of is called Symmetry Financial Group. This is an insurance broker that has been recognized by Inc. magazine as one of the top 5,000 fastest growing company in the last 6 years in a row. We also just got a very prestigious award, the Stevie Award. And the entrepreneur have also give us the award for cultural, you know, the company culture. Okay, so it's very, very well recognized. Now, how we do that is because we partner with at least 30 to 40 top rated insurance carriers. Okay, and I'm sure you can recognize most of those names. And also the way we do it is because we really take care of protecting the life journey. As you can see in the area of life, health, and wealth. And today we're gonna focus in the area of wealth, but just keep in mind that we can help our clients in all those different areas, okay? So one of the most popular programs that we have is called Debt Free Life. The name said it all, right? Debt free. And one of the reasons that we really like this program and our client love this program is because we have been able to adjust it to newborn babies all the way to retirees and everything in between. And especially as today we have realtors, this is a great program for business owners, entrepreneurs, self-employees. It provide a business solution, and we say you can eliminate debt and build wealth without spending any additional money. So part of this program, let me go to this one. Part of this program is in relationship to the maximization of your resources. Okay, so for that, in that part, we use software that when we know the debts that the company have or the family have, it can be real estate debt or a card or credit card. We have this software that when we put the information with the interest and how they're paying that, it works into maximizing the way of paying those debt. And we use a couple concepts that we're not gonna get into that now, but just be aware that when the person have a lot of debt or any amount of debt, this software will calculate what is the most efficient way to pay those debt. And one of the concepts that we use in that maximization is the infinite banking. And that infinite banking, we focus more in the accumulation, okay? So see, we say here, use every dollar twice, okay? So by the end of this presentation, you're gonna know exactly what we mean by that and also how it can be implemented in your business, okay? And of course, if we do maximization and accumulation in a correct way, efficient way, then our distribution for retirement in the future is gonna be very comfortable, okay? All right, so when we said infinite banking, right, it gives the idea, of course, that we're talking about bank, but let's keep in mind, this is gonna be you being the bank, okay? So let's see how the banks work, and then we're gonna see how that can apply to your particular situation. Okay, so the resources for the bank is money, is cash, right? So is you either do your purchase, you know, with cash, or you utilize credit, okay? So yes, you don't need to tell me, you can put that in the chat, or you want to just keep it for yourself, that how much money passed by your hand during a year with everything, you know, if you're a real estate, you know, all the commission that passed, and you know, if you have any other source of income, how much money passed by your hand within a year, right? And it's calculated that $2 million passed by the hand of every person during their lifetime. And on average, unfortunately, only about 69,000 on average is the person have by the time of retirement, okay? So out of you, I guess you have that number in your mind now, how much money passed by your hand every year. So multiply that, let's say by 10. And the thing is, will you like to keep some of that money? Because when you use it to pay all your bills, that money is gone, right? It's like water. You cannot save it, you cannot invest it, it's gone, right? On the other hand, if you use a credit and financing, then somebody else is using their money to benefit themselves, right? And they're using, actually, I would say, your money for their benefit, right? So either way, if you pay cash, all this money gonna go out, or if you use credit, with even more, because all this money, you're helping somebody else, but you're not helping you, okay? So that's basically what the bank uses as resources, and let's see how the bank uses it to his own benefit. Okay. So let's say, right, that Christian, you go to the bank and open a saving account, all right? And you put $10,000 there. Okay, but the next day happened that, you know, something broke in your car, whatever, and you need a loan. And then you go back to the bank and ask them for a loan of 10,000, right? You don't want to use your savings. And they're going to charge you, let's say 5%, right? You have great credit, right? 5%, but the interest that you're earning is 0.005% or something, right? So that is called positive arbitrage for the bank, meaning that it's positive for the bank because when you give them money, they just have to give you a little, but when you borrow money from them, you need to give it a lot more, okay? That is a very important concept, positive arbitrage. But then what happened is that the bank repeat that, is able to do that 7 times. In other words, it takes your 10,000, Christian, and loan it to Michelle and charge 10%. Then they loan it to me and charge another 15%. Okay, and so forth and so on. So at the end, the bank had made probably at least another $10,000 out of your 10,000. Okay, and then you need the $10,000 then, and you go to the bank. Okay, I need to close that account. They said, here your 10,000, Christian, and here $100 for you. Thank you very much. Okay, so that's how the bank is using that positive arbitrage to grow their money. Where we are not gaining anything with that, right? We cannot put it in the bank or anything because it's not earning. So that's basically the concept of the positive arbitrage in the bank, okay? So when you see this, right, that is the question, you know, do you think it's time to fire your bank and control your finances, right? How will it be? Who will want to be here? The bank, then, you know, you can put in the chat if you would like to be the bank, right? Instead of letting them gain on your money, correct? Okay, so in just a few words, that is the concept of infinite banking, meaning that you are going to bypass the bank and you're going to use your resources to do the positive arbitrage to work for yourself. That is, in a few words, the concept of infinite banking. Now, the main question will be, right, so how do you do that? Because do we start a business, a bank, everybody, you know? So what is the way that you can do that? Now, at the beginning, we were talking and some of the people were saying that it's a new concept for them. So can you put in the chat if this is a new concept for you, or is something that you have heard before about infinite banking or banking yourself, or is this new? Okay, why? It's not a new concept. Actually, it has been used for probably more than 100 years. Okay, and these are some of the people that have used that concept for themselves, for their own finances. There is a book called What a Rockefeller Will Do, and it's based on this infinite banking concept. And they like it so much that they put it into a trust. Okay, and it goes generation to generation. Now, these particular people that you see here and many others and many financial institutions and businessmen and women, they have used this concept, and something that each one of them have in common is that they have used it for their business. That actually, Ray Kroc actually used it for real estate because he used the infinite banking to acquire the land for the McDonald's. Okay, so Walt Disney used it to build his park, and no bank wanted to loan money to him because, you know, for the liability, the roller coasters and all that. But each one of them were able to use their own infinite banking to further their business. So it's a concept that's been around for many, many years. I call it the best kept secret among wealthy people. Okay, so now what vehicle they use, right? How they were able to establish that positive arbitrage for themselves. This is what they use. They use a particular type of insurance that is called participating whole life insurance. Okay, this is a very particular type of insurance products that have different features than any other life insurance. Okay, so what are the different features of this product? Okay, when you pay your premiums to this life insurance policy, part of the premium go to cover the cost of the insurance, but other part of that premium go to, I call it a savings account, which is called a cash value account. Okay, now see how that cash value grow. First, it have a guaranteed interest by the insurance company. Okay, and typically it's between 3 or 4%. That's guaranteed. Okay, every year. In addition to that, it receives annual dividends. After you have shares on that life insurance that have more than 100 years producing dividends. Okay, so you get a dividend every year. Okay, we work with 3 companies. Each of them had more than 100 year old, and every year they have declared dividend, except for 1 year, one of the company during the war or something like that. And then in addition to that, they allow you to fund that cash value. Okay, just like a saving account. And that funding of the cash value will receive this benefit, the guaranteed interest, the dividends, okay? And all this cash value is not exposed to the market losses. So it's not, people that have this program are very happy, even with what's going on in the market, because they're not affected with it. And all this cash value is growing compounded every single year. Okay, is compounded interest. And of course, being a life insurance policy, it had the feature that when the person passed away, they all their loved one get all the death benefit tax-free. It also have something called living benefit, that is you can have access to the part of the death benefit while you're still alive if certain health condition are there. And in this particular case, this product, the death benefit increases every year because it's reflecting the increase in your cash value. Okay, so all those features for the participating whole life. Now, how can you use then that cash value that is very nicely being accumulated in that account? Of course, if you close the account, you get all the cash value, all right? Or if you cash a portion of it, you can do that. This cash value is immediately available and it doesn't have any fees or penalties, okay? It's not like the, the 401k or that you need to wait for certain age or none of that, okay? Now, the two other ways to use the cash value that made this particular program like a bank, work like a bank, is the following. These companies are what is called no loan recognition. What that means is that if you have, going back to the $10,000 that from the saving account, right? If you put that in your, to fund your infinite banking, and then you need $5,000 out of that, let's say. When you borrow the $5,000 to a low interest rate, the full amount of the cash value continue to receiving all the interest and the all the benefits and all the features. In other words, I said it's in a simpler terms, right? They keep your money in one pocket, but they loan the money from another pocket, okay? So this is what is gonna do a positive arbitrage to work for you. Because in this case, the money that you're loaning from your policy, and actually you're paying the interest basically to you, is the interest rate is lower than what you're earning with the dividends, the interest, the compounding during the same amount of time, okay? And finally, there is a rule 7702 that from the IRS that said that the money loan from general life insurance is not taxable, okay? So there is a way to structure this so you can, when you wanna take the money like for retirement or something, you can basically borrow the money out of the death benefit, and then you don't have to pay back and you don't have to pay any taxes. So it makes a huge difference compared to any other investment account, okay? All right, so let's go to number, and again, if you have a question, let's put it to the end, okay? But don't write it down or something, and I will go to that, okay? So, but that's the most important concept, the no loan recognition, because that's what it makes it work like a bank. Positive arbitrage for you. Okay, so let's see a numeric example, okay, of what happened with those resources there, how you can leverage that cash value. Okay, let's suppose that you have $15,000 in a saving account, a regular bank saving account, and you need that money. You can take it from your saving account. Of course, it's not going to continue earning any money, right? But then you decided that you in 3 years, you want to save another $15,000, and you go ahead and do that. Well, at the end of the 3 years, you're going to have your $15,000 and approximately probably $150 more if the saving account earn 0.5% in interest rate. So which is kind of high for regular savings account, right? Now, what happens if you don't have those resources and you need to take it from a bank or credit card? Now, I put 5% there. I know it's going to be a little more, but just to compare a little bit of apples to apples, let's say that the bank will charge you 5%. You pay back in 3 years, okay? They determine that you need to do that at 5%. At the end of the 3 years, you have been negative, right? 16,500, but at least you got the 15,000 that you needed for whatever reason, 3 years before that. Now, what is the difference when you have your own infinite banking setup? and you have a 15,000 there in your cash value available, right? So you make a loan and you are the one who set out the condition of how you want to pay it. So in this case, you say, okay, I'm going to pay in 3 years. And typically the interest rate that the insurance company will charge you is about 5%. And you do the same, you pay yourself back. At the end of the 3 years, you had paid basically back into your cash value account 16,500. But this is the huge difference that there is with any other program. The 15,000 have continued earnings, interest, dividends, compounding interest during those 3 years. So when you see your cash value availability at the end of the 3 years, it's going to be in this neighborhood, 17,364. Now, when we work with real estate agents, I know those numbers are a lot higher. You know, some real estate agents, what they do actually is they finance a home and they rent it or something, and that pay the back that debt, and they sometimes they open another of this bank for another property. I mean, they have a lot of fun with this program. So I did something similar with the numbers. If we're talking about $50,000, okay? We recently did one for someone that wanted to do it with real estate, and he's gonna put 76,000 a year, because that's the way you real estate, you work with a lot of capital, right? Okay, so with the $50,000, of course, at the end of the 3 year in the saving bank, they're gonna have $50,785. If they ask from the credit card or the bank, same situation with 50,000, they will have paid 57,500, so they have lost 7,500. But if they utilize their infinite banking, at the end of the 5 years, actually I did it with the 5 years, they're gonna have 63,813. So that's what we say, you use the same dollars twice, 2 different ways, okay? This is the only financial vehicle that allow you from this with the same resources to put it invested or save it, earning, and at the same time use it to finance your purchases. It's the only one. That's why you say use the same dollar twice. Okay, so this next one is kind of a summary of how the plan works. First, you redirect your funds into your bank, right? And then that's going to start grow your cash value with the feature I mentioned it. And of course, you can have a tax-free legacy, and also, honestly, the tax-free retirement if you want to use it for that end. But during that time, you're going to use your bank to finance your purchase and then pay back. And we call this recycle your dollars over and over and over while it's growing. Okay, so that's how you can create wealth and leave a legacy, by leveraging your life insurance cash value. Okay, so that's basically the concept of infinite banking. And for businesses, as I say, is a very, very important tool, because, for example, like Michelle was saying at the beginning, for real estate, they don't have a certain amount that they know are going to get every month. All right. So what happened? These plans are very flexible. You can determine, okay, I want to put this amount of money every year. So you put, when you have some money, you put it there. You don't have the money, don't put it back. Don't put any more there. But that is growing the whole time. And the businesses have the situation that they need to have some reserve. Okay, you as a realtors, you need to have some reserve for the months that the business didn't go as well, right? But if you had those reserves in the bank, they are, we call it lazy money. You're not making any money with that. In this case, you have your reserves that are available to you if you need it, and you in their earnings during that time. On the other hand, when in the businesses, when you need credit, you need to be approved, you don't know the interest you're gonna get, so forth and so on. In this case, it becomes your own line of credit that you approve yourself, okay? You are the one who approves yourself for the credit, and you yourself pay you back, and so forth. So it is the best of both worlds. And also, when it comes to taxes, again, we can structure in a way that if you take it as a loan, you don't need to pay the taxes. And also, very important is that one thing, you don't need to wait until you are 59 and a half to utilize those resources. And for businesses, depend on the type of business that you have. Is it an S corporation or LLC? I mean, we don't give tax advisor or some, but in some cases, you talk to your tax advisor, and this program can be funded by your corporation. With your, as an executive, it can be a bonus to that. It's a 164 bonus program for corporation, and then that will be a tax deduction for your company. So it can be funded for your company, okay? And you are the executive, right? So you're the one to approve that anyway. It's very flexible. All right, so I guess sometimes people ask, when is the best time to start this program? And normally I say before you spend $1 more. We say, let's try to sequester all these resources and make it work for you forever, right? And then you do, if you need it for anything, you can take it. We use primary sources of funding, like your savings or extra money or discretionary money, but also there's very creative ways to put the money there, like the money that you want to pay for the taxes, or some people put the escrow. So it's many different ways that we can fund this account. To pay credit card especially, oh my goodness, the interest rate, the credit card, yes, by putting the money here first and then pay your credit card, yes, with that movement, you have reduced your interest rate payment from 29% to 5%. Yes, that is a huge advantage, not even taking in consideration that that money there is also earning more interest in growing. All right, so basically what we do with this now, because we customize her to each person, each one is different. Each one of these plans is gonna be a perfect fit for your particular situation. It's no one size fits all, right? So how we do it is we identify first your personal needs and your business, what you want to do. Some people, again, a lot of our clients are real estate, they utilize it for their businesses, right? And then we identify the ways to capitalize those, and we go from there. So the next step that we do is to have a time when we can see what is you want to do with an infinite banking, how you want to develop it, and we set up a customized plan for you, so you can see how will that work in your particular situation. Depend how many. Some people have, if you have debts, then we take that in consideration, how to pay faster. We have some people even, I know, Jorge, he have utilized that for his daughter, and they're gonna pay their home in much less time that they expected to pay. So by the way, Jorge, you want to take just 1 minute to share how you utilize this program? Jorge is a real estate, how you utilize this program for your daughter paying off her house?
Yeah, I'll be glad to. Yeah, one will actually have 3 daughters, and my middle daughter, when she went to school, I did help her for like 3 years, but the last year it got too expensive that she got to get a loan. And but when she got a job, she paid it off utilizing this infinite banking, and now she's enjoying the fact that she has some cash value accumulated, and now she can purchase a home. So that is one of my daughters. The other one, she just recently she became a nurse, graduated as a nurse, and now she's working. So she bought a car, And now instead of paying the car off in 5 years, she's going to be able to pay it in less than 2 years. And my oldest daughter, she recently bought a house after, me selling her first home. And now she's going to be able to pay her home off in about 11 years and 8 months. And she didn't have much debt, but yeah, it's been a great program, and to educate my own children. So yes, it's been great. Thank you.
Yes, the other thing that is that with this program, it washes off the cost of insurance. Sometime in 2 or 3 years, it's like having a life insurance for free, and if that life insurance grows tremendously, and then it's for free, because the growing of the cash value surpass all the funding that you have put there, not only for the cash value but for the cost. So it's wash off every cost that you have. That's another great feature. So let me see if any questions that anybody have.
Yeah, I have a
Hi,
cash
Carmen.
value. My name is
Go ahead.
Carmen. Can you hear me?
Yes, Carmen, go ahead.
So I have a cash value policy, and it does accumulate cash value. But from what I understand that you're saying is that you can take a loan against your cash value, or you can
Yeah.
take a loan against the principal.
You can take a loan about the cash value, but this is the thing. There are many different type of policies, let's put it like that, different types. So the best, we always need to see exactly how is it structured, because they can be structured many different ways. So, but yeah, in general, you can take a loan of your cash value.
And so the loan would be what percentage?
Oh, yeah, and depend on the carriers, but in most, the one that we work with, general, you can take into 95% of the cash value available. Yeah.
But I'm saying, okay, you can take 99% of the cash value, but what interest rate am I paying on that loan?
Right. That's why depend of how your policy have established it, because there are some, for example, we work with some that they say the 5% is the maximum that they can charge you. Another one says variable, but it cannot be more than 8%. So most of them right now is like between 4 and 5%. That's all that they charge. But there are other companies other carriers, that they charge a lot more, so it's not worthwhile making a loan. There's many different terms of how that loans are. In general, you can borrow cash value for just about any life insurance policy, but it's important to see what are the terms that the policy have established for those loans. Sometimes it's fixed interest, sometimes it's variable interest. So we will need to see in your case, how much is the interest, if it's fixable, is it fixed interest or variable, and what are the terms of that particular cash value in your policy
So
for the loan.
it still keeps accumulating, even though I have that loan, all right?
Again, and the one that we have, yes.
Okay.
The one that we have, yes, but not all, like, for example, let me give you an example. There is another one that we don't work with. And if you borrow the money, then the best they can do is just put a zero, but you don't earn anything in the money that you borrow. That not all policies are created equal. The one that we have, because that's the benefit to have access to 40 carriers. Okay, so we can look around the spectrum and find the one that are no loan recognition, completely no loan recognition, meaning that you have a loan and you still are going to be earning everything, the interest, the dividends, because not all of them do that. Okay, so I'd be happy to see the one that you have and see what are the terms or how that work in that case, because it's not across the board that there will be no loan recognition.
So you can never borrow against the principal.
Well,
if it's $100,000 policy, then you can never borrow against the $100,000
Oh, you
$100,000.
mean, yeah, the death benefit? No, because
okay.
no,
So,
not
and
yet.
then the other part is, okay, let's say I owe $10,000 in credit cards, for example.
Mhm. Right,
And I want to pay that off in 3 years.
Right.
So in your synopsis of giving me the right life insurance, you're going to show me the cash value accumulating in 3 years.
correct,
Pay off that debt, right?
correct. Actually,
so
that's,
then-
yeah. Mhm,
So
go ahead.
then those funds will be taken from the bank to pay for the policy. And then the next 3 years, I'll be debt free. Or the next 2 years, I'll be debt free, depending on the monthly payment I make and what goes to the cash value and the principal.
Yes, and that's precisely, we have a software that do that. And I mean, people get so impressed when they have this, like Jorge was saying, originally the mortgage and everything was going to be paying in 30 years, and after we run the software and put these plans there, typically it's about 9 years for them to pay off everything. So absolutely. And talking about that, there is my Calendly, the link. You can click there and find a time. I'd be happy, Carmen, to have a Zoom with you and see your specific situation. And if you can have handy the term of the policy that you have, and you can even ask them, call them and ask them how much cash value you currently have. And we can see.
I know how much cash value I have there, but what I'm saying is that I just wanted to understand how
Yes.
do you make someone debt free? And
Yes.
how do you work that plan? And also, I don't mean to take the stage here, but
That's fine.
I just wanted to learn the concept of, being debt free, and how do you, on a prospective consultant side, share the different plans that you have to make you debt free and the consistency of the payments.
Absolutely. Yeah. So if you can click in the link and set aside a time, and then we're gonna go with a lot more details. But just for now, what it does is just take all the debt that you have and see how can be paid more efficiently. With a couple of concepts that we have, and also depend what will be more efficient, if we will pay the smaller to the bigger, so the bigger interest to the lower, and adding that infinite bank